So we closed last week at the lower end of this range for the S&P 500. You can see the support, so the lower end of the range right here, and the top over here, the resistance of this range that's been trading within now. What's interesting about this is whenever you see these ranges that the market trades within, whenever they break, whether it be break down or break out to the upside, so both scenarios here, you see an extended move in that direction. What's critical about this is watching for when those breaks occur. We're at the lower end of the range now. This is a decent 15-minute candle or two 15-minute candles that we had on the low for OPEX. So that was last Friday. So this will probably hold at least going into the Monday session. It is very dependent on where the overnight session is. But regardless of that, you're going to want to see a breakdown of this 508.82 level in order for there to be a breakdown of the larger scale range that I just showed you here. As long as this stays defended, we're going to see continued bounces within the range for as long as it chooses. I doubt it's going to be much longer, but we're going to see continued bounces to the top, followed by downside all the way to the lower end, kind of like it's been trading so far, since that's how ranges trade. So what's going to be critical for early this week is watching to see if the lower end of this range holds. So this 508.82 level, very critical. We have kind of an inverse head and shoulders pattern here. It's not necessarily perfect, but still we have a possible left shoulder here, head, and then the right shoulder that formed on Friday. If we have something like a flat open or a gap up, I actually favor short-term bullish upside. Now, of course, it's going to be interesting to see what happens once it goes a bit higher here. We have clear supply, at least micro supply over here, where this hard rejection occurred on the 50-minute candle. You could see by the wick of this 50-minute candle, as well as the wick over here, followed by the downside. So there, of course, are key resistances as we go up. But right now, it looks like it's basing relatively safe around the lower end of the range. Going into the rest of the week, though, if let's say we were to have a bounce on Monday, it goes up to around, let's say 512, 513 and rejects because it's not yet ready to fill the gap down that we had from between Thursday and Friday of last week. If we had a rejection and it went back down to the lower end, that shows weakness because characteristically, anytime we've touched the lower end of this range, as you can go back to early March, for example, anytime we touched the lower end of this range, it went all the way to the top. Of course, it was set, the top was set around this time period here, but still, you could see it was set over here, went down to the lower end of the range, found support off the same level, went all the way back up, top end of the range over here, and now we're all the way back down to the bottom of it, just like I shared with you how these ranges like to trade, to the top, to the bottom, to the top, to the bottom, until it decides to break in either direction. If we were to only bounce and kind of go halfway, kind of that halfway point around 513-ish here on SPY, and it fell back down below, I would actually favor a breakdown in that scenario because that shows weakness to the trend. The trend so far, at least in the short term with this consolidation, has been all the way to the top, to the bottom, top to the bottom, like I've now said a couple times, just to really make sure you guys understand it and plant it in your head because this is key since this range will result in a very critical breakout / breakdown depending on which direction it chooses. So watch for this to happen. If this happened and it kind of loses and kind of has bullish exhaustion, we see bulls get exhausted on the way up around this mid-range here and it falls back down, then we're looking at a possible breakdown scenario. If we see it go all the way up here, finds support off of a potential retracement, and continues all the way up, fills the gap from Thursday to Friday of last week, which negates a lot of that bearish momentum, then we're probably seeing at the very least the top end of the range, and then the inverse would apply for potential breakout if it chooses to do the same thing and find support off the mid-range off of a retest. But regardless of that, this is just basic price dynamics within a range. This is what I'm watching for this week because the large-scale move that we're all waiting for right now is going to be dependent on which direction it chooses to break this range. So far, it's found a lot of support around the lower end here, and of course, resistance as well on the top end of it. I'm waiting, at least for the next large setup, for this range to break. So as long as it stays within the range, I'll look for shorter term setups. Right now, not a bad idea, at least in my opinion, to have a long setup around this range here for this possible inverse head and shoulders. We have a nice 50-minute structure, a squeeze structure actually based on Friday's price action here, where we saw a little bit of a dump on this 15-minute candle here, followed by upside immediately right after to go a little bit higher. And so far it's basing relatively well. It's not bad risk reward either because you can use the low from last Friday as your risk. So risk in this case is around 508.50, let's say. And depending on where it opens tomorrow morning, we could see like, let's say 510 or maybe mid 509, you're looking at about a buck and a half risk for potential reward of it going a lot higher to the mid range, like I referenced before, 512, 513, before it decides where it wants to go next. So that's what I'm watching in both the short term view, that kind of long setup that I'm looking at here, and then also the macro view, depending on which direction it wants to break, whether it be down or up. This is going to decide a lot going into Q2 of 2024. So I'm watching this, especially for this week, because I expect we'll have that result of the break-in trend very soon. And something else I do want to reference here that supports that kind of short-term bullish theme is look at this XPX flow that we saw from Friday. Now, one thing I do want to mention here is XPX flow is not always going to be directional. Actually, it's often a hedging that you see, or it's possible spread positions that we see on here. So it's not like just because you see all of this green on your screen here that it's bullish directional bets on every single one. It's kind of difficult to gauge whenever you're looking at SPX or SPY, the ETF, or QQQ, the ETF. So it's going to be a bit more difficult than if you were to look at, let's say, a ticker like Microsoft or Tesla. Those tend to be more directional versus here, you can see a lot of hedges. However, when you see a lot of one color, in this case, you're seeing a lot of green, a lot of these calls back to back to back to back, a very similar shorter term expiration like May and June. These are quite a bit out the money. That can certainly give you at least some type of confirmation bias to that trade setup. Of course, you still have to use good risk reward setups or good risk reward practices, as you always should in any type of setup. But still, this is relatively bullish that we saw this on Friday, especially for the May and June expiration. A lot of these prints were coming through consistently, and that's basically the extent of what I would use XPX flow for, because if you see things, especially like earlier on in the session, actually it's very bullish throughout the session, but if you see things like this earlier on in the session, it's kind of just not necessarily directional. I mean, we see a couple bearish prints here, like these calls being sold or a put being bought, followed by some bullish prints after, and it's not very directional until we see a lot of these calls start to come in here, a lot of puts being sold, and then we go all the way up to the ones that I just showed you, a lot more bullish prints later on in the session. That's where you can start to see a skew towards the bullish side. You really need to see a lot of these prints, though, in order to have a little bit of a bias for that bias that they have, in this case, the whales. But regardless of that comment, we saw a lot of these around the low of day from Friday over here. So that's good to see that there was potentially some bullish emphasis off the low of day. And that's a theme that I'll want to see on Monday to see continuation to the trend of this upside that we've seen, at least in the very short term. So that's something that I'm watching. Another thing I'm watching is dark pool levels. Of course, Friday was OPEX. You're going to see some larger than usual prints. However, this still is a $4.7 billion print at the 412.97 level. That is a key level to mark for this week. If bulls can get over that, that'd actually be very bullish. As of now, we're under that on not only the daily, but also the weekly candle. So a little bit more of a bearish emphasis based on this. And of course, because it was OPEX, we're going to have some other large prints like this 1.9 billion and this 2.4 billion, roughly around the same level over here. So we're looking at about 4 billion plus of total premium here around this 509.65-ish level. So that's critical. And then a little bit lower here, 3 billion and 2.7 billion around the 508 low levels here. So a lot of premium to go around, not necessarily a surprise since it was a quarterly OPEX. We tend to see those large prints for quarterly OPEXs, but still some very critical prints, especially this 4.7 billion one, because if we can get over this, that'd actually be very bullish in the short term. But as long as we stay below, we're looking at a bit more chop over here until the lower end of this range can break, which of course that would unleash the macro level move that I'm kind of watching for, which would result in a lot more downside. But until that can happen, we're looking at a lot more chop in between this range, especially between where this 512.97 current resistance is. But that's what I'm watching for this week. We do have FOMC approaching. I'm watching the VIX as well. It's probably the last thing I'll share in the video here. I am watching the VIX. It's been relatively heightened recently, especially compared to where it was earlier on in the year. We're seeing it stay relatively stable around the 13s to 14s so far, which is fairly new overall. Not necessarily a surprise with something like FOMC approaching. You're going to see more hedges heading into that, just the reality of the market, especially for a key meeting like the one this week, which we're going to have some insight on when they're ready to cut rates in the future. That's critical to the market. Going to get a good sense of their plans going forward. And realistically, it's pretty common to see a VIX crush where we see that suppression of the VIX after big events like FOMC. We've seen that countless times, like every FOMC recently has been very similar, where you see that VIX crush afterwards. So that's something to watch for, at least later on in this week. Something that is very common, assuming that Powell doesn't say anything that's really unseen, because of course if he pulls out something that nobody was looking for, then that can result in the opposite of a VIX crush, and we see the VIX continue a lot higher. But considering that the last couple meetings at least have been nothing really new that we didn't know, a lot of those have resulted in the VIX crush. So keep that in mind going forward, because if that is to be the case, and even if we were to trade still around this lower end of the range going into FOMC, or if it finds support off the FOMC or post FOMC volatility around this 508.82 level, you're probably going to see some type of VIX crush, which of course would be the inverse on the S&P 500. You'd see more upside coming off of that. Just tends to be the case when those hedges roll off after the event. So something to watch for this week. I'll be watching the event, see what happens there. And other than that, really my main focus is the S&P 500 for this week, just because we are near the lower end of the range. Even though in the short term, looks like there could be a potential bounce from here, we are getting relatively close to what I think would be that trend break or range break that I referenced a lot earlier in this video. So that's going to be something that is going to set an extended trend going forward here. And I want to make sure that I'm on the right side of that trend, as I assume you guys want to be as well. But regardless of that, appreciate you guys as always watching this video, and I'll see you next time.